Hello, everyone. Welcome back to the Final Bar. This is Dave Keller, strategist at StockCharts.com. I want to welcome on my guest, Will Geisdorf from Ned Davis Research. Will, thanks so much for coming on the show. Good to have you on.
Oh, thanks for having me, Dave.
And I have to tell you, on a day like today, this is the beginning of what they call, I think, the big dark or something like that, where Seattle becomes a little more overcast, a little more rainy. I think of you in Florida, and I always did this in Boston. We had a heavy snowstorm. I think of what Will was doing at this moment. I always had pictures of you golfing, doing something fun. So tell me you're doing something like that at some point in the week, all right?
Yeah, no, definitely will.
So you sent a chart ahead of time. Thanks so much for doing that. Looking at stocks versus bonds. Can you talk through what you sent and what it means to you?
Yeah, so this is a chart that we featured in a publication this week where we've just been really seeing for the entire year that the stock bond ratio has been consolidating. We haven't seen a clear uptrend or downtrend. And one of the ways I tried to kind of put some context around it was to just look at the stock bond ratio, which is the blue line in the chart, and its relationship to its 1-year average. And I just put some barriers saying, well, how long is it traded within 5% of its 1-year average? And the bottom part of the chart almost looks like shark's teeth. That's basically just telling you how many weeks in a row that the stock bond ratio has been within 5% of its 1-year average. And it really stands out. As of last week, we're at 39 consecutive weeks. So basically the entire year, we've been glued to the 1-year average. And we haven't seen this type of consolidation since the early 90s. And so we've been experiencing it. And I mean, we're trend followers at Ned Davis, and you get whipsawed somewhat when you have these types of tight consolidations. And so one was kind of putting some context around it, and then kind of looking at what are the catalysts that are going to get us eventually to break out of this consolidation.
It's interesting, and I love seeing a chart that sort of summarizes how the market feels, right? It feels like this. It feels like there's this sort of balance or sort of this indecision, and the question is just which way we move. From a technical perspective, is there anything you're seeing that would give any sort of color on which way you see this breaking, or is it more of a macro call at this point?
Well, I mean, from a technical standpoint, usually these types of consolidations are resolved in the direction of what was the previous trend. And if you look at this chart, we were in a clear uptrend since 2009. So just from a pure technical standpoint, I would expect that we get eventually a resolution to the upside. I mean, our belief is that stocks versus bonds, we're in a secular bull market right now. And then just from a macro standpoint, I think really what would cause a breakdown would be a U.S. recession, and that's just not our macro team's base case. So the technicals and my kind of macro read both point to an eventual upside breakout.
Very interesting. And I love, I've followed, Ned Davis and your work obviously for years, enjoyed reading it in my Fidelity time. And I always loved how you combined the technical with other disciplines, right? It was sort of part of the puzzle. It wasn't the entire puzzle, it was part of it. So when you're talking to clients or when you're providing your content, how do you sort of point them, or how do you encourage them to use the charts in relationship to other things? Where should it fit into someone's process, do you think?
Yeah, well, I mean, a lot of our clients, our big institutional clients, are more of kind of a macro fundamental discipline, or they come from that. And we always say, the macro and fundamentals tell us what the market should be doing, and the technicals tell you if it is doing that. And so a lot of our clients, I mean, for me, it's if they have a strong view one way or the other as to stocks versus bonds, this kind of provides a little bit of reality. And so, we've gone nowhere this year. And so the technicals are a bit of a check to someone's strongly held fundamental and macro views. So that's where the technicals really can provide some discipline.
That's great. One of my former analysts used to say the charts are the truth serum for the markets. They tell you what's actually happening. You can't second guess it. So going back, if we could, just to wrap up, so it seems certainly more constructive, stocks over bonds. That all else being equal, looks like the potential future path according to your work. What would maybe tell you you're wrong, or what would you see that might tell you that that's not the right call? Would it be something, some sort of breakdown on this particular ratio, or would it be more an individual look at stocks or bonds separately? What would it be?
I would say if we start to see the macro backdrop in the U.S. Weaken substantially, that would be right now we see little threat of a recession this year. So it would have to be. I mean, we have a number of indicators we're watching for kind of key level recessionary levels. We'd have to see a few more of those indicators check the recessionary box for me to think that we're going to that my expectations for a breakout to the upside are incorrect.
Perfect. That's a fantastic chart. A really good take on the markets. Will Geisdorf, thanks so much for joining us today. Really appreciate it.
Thanks for having me, Dave.